oracles. So the Fed cut rates by 50 basis points this week. This marks the first rate cut that we have seen in many years, and the first rate cut since the Fed stopped hiking rates last year. So, what does that mean for the market going forward? Well, we had a video about that the other day discussing some of the potential scenarios, but there's an eerie and scary similarity to what we had seen this rate cut to what we saw during the rate cuts during the great financial crisis. So I'm going to dive into that, all of the eerie similarities, the timing of it all, and are we going to play out the same way or will this time be different? So we'll discuss some of that. We'll discuss kind of different scenarios that we can see playing out because of that historical data. What's the same? What's different? So we'll get into that in just a minute. Now, if this is some content that you guys like to see, please don't forget to hit that like button down below, subscribe to the channel. It really helps with that algorithm. All right, so looking back 17 years ago to the day, on September 18th, 2007, the Fed cut rates by 50 basis points. And now at that point, they weren't recovering from a pandemic that they had just gone through several years beforehand. There was actually a pretty decent market going up to that because they were still recovering from the dot-com bubble that happened 7 years prior to that. So they had kind of been on an upward stream, but there was a lot of things obviously that we know now going back underlying in the housing market that was going on. Now, we have mortgage-backed securities today that are similar to what they had seen back then when it was all the subprime loans and things that were going on. Now, today, the credit standards are supposedly better than they were back then. And people are held to higher standards to get their mortgages and to get their loans. So that underlying piece as far as the housing market goes should be the same. However, when I look at other rates that are going on and you see credit card rates that are sky high, people having their limits capped out when it comes to those credit cards, people don't have that kind of money. So maybe it's not going to be the mortgage rates that are going to be the tipping point when it comes to this time around. Maybe it's going to be rates in other areas, because even though the Fed just cut rates right now, we are seeing yields going down. And when you look at things that happen like this, the Fed cuts the rates, everybody thinks, oh, great, things are going to be coming down in price. It's going to be less expensive for everyone for different things, when it comes to getting mortgage rates and things like that. Not necessarily. What you're going to end up seeing in a scenario like this is the Fed comes down on rates, but guess what also is going to come down? High yield savings. So the yields that you were getting on your savings coming down. The yield that you're going to be getting on the treasuries and bonds, those are going to end up coming down. A lot of yields that you are going to be getting and people getting for income will also be coming down. The benefits that people see from a consumer standpoint or even a small business standpoint, the benefits are going to be lagging. Those might take a year or two for people to actually recognize the benefits of those. Meanwhile, a lot of the small businesses in particular are still feeling the effects of the rate hikes that are going on. So we're in this middle zone right now where the small businesses are still feeling the rate hikes that are going on, but we're going to see the very wealthy people are going to be actually reaping benefits because they were primed and ready for this. Now they can go and buy things. So as companies start to falter, this is where Berkshire Hathaway with $300 billion sitting on the sidelines, they can go over there and say, hey, these companies are starting to default. These companies are in issues, but they're actually not bad companies. Let me go ahead and buy those up. This is that time where we end up seeing massive corporations buying up other companies right now. And as the rates come down, they're the ones who can actually borrow for cheaper because they have much better credit. Meanwhile, all the small businesses who already took on a ton of loans just to be able to get themselves by over the last few years have massive high interest rates on all of those loans. They're struggling to pay those off as it is. They can't take on more loans because they're already buried in debt as it is. So maybe this time around, it's not going to be the mortgages that are actually going to be the tipping point, but it's going to be a different area of credit. Now, that's just one bearish scenario that could end up playing out. But let's take a look at the eerie timing that we had seen when it comes to the 50 basis point cut this time to the 50 basis point cut in September 18th of 2007. So first, we'll dip back to the Fed actually going up on rate. Look at this, 1.25% in 2004. So here it is, 25 basis points steady for basically 2 years straight, getting them from a 1.25 to guess where we just were, 5.25%. So that magic number, the 5.25%, is just where we were, and it was a 25 basis point hike, and it was June of 2006. Now, when you look at the cycle that we had just gone through, the last time the Fed raised rates was July 26th of 2023, and they went up by 25 basis points. So here it is, Just a little over 1 year later, they cut it by 50. So now we go back down to here, 25 basis points. The last time they go up to 5.25, and then you move up here to just a little bit over a year later on September 18th, they cut by 50 basis points. Now, what did we also hear from the Fed about how they're most likely going to be getting to 100 basis point cuts this year, which leads us to believe that we'll be getting 25 basis point cuts the next two meetings. The next two meetings, the next one is going to be coming the day after the election, so it'll be early November, and then mid December will be the next one. Again, 25 basis points. That is what we are expecting as of right now from the Fed, which will put us at the exact same Fed funds rate as we saw in 2007. And then it was at that point where they recognized that they were in trouble, so they had to cut by 75, 50, and 75 again. And at this point, we were already on that huge downward slide in the market. So at this point, the Fed was just trying to play catch up, and they had to get in front of this to try and catch it before it crashed even harder than it already was. So then the question is, where was the market at that point? Well, as we had discussed several years ago, when the Fed pauses rate hikes, which would have been in June 2026, we historically see a massive run up in the market. So sure enough, from June 2006 until that rate cut in September, we saw a massive run up in the stock market. Then, when we see the Fed cut rates, typically it doesn't happen right away where the market just sells off because the market wants to see rates getting cut because that's going to be a bullish signal for the markets to grow even further. But what happens here? September 21st. Now, this isn't exact on the dates, but we see the market goes up for the next few weeks. Then it was in mid October where the slide started happening. And it didn't happen right away. So sure enough, you see October goes down, comes back up. Look at that little early December rally back up over 1500 and then dips down, and then boom, February, and then we just slide down from there all the way till March of 2009. It was a fast free fall, and it started in the middle of October. But we saw a couple of bumps along the way that brought us back up to give us that false hope that, hey, it's really not as bad as we think. But there was underlying issues that caused this to collapse. And so when you look at where we are today, here, we saw the Fed cut rates, and sure, we saw that dip down here in August when we had the Japanese carry trade going on. But since then, we've been moving on up. But historically, when the Fed pauses rates, we see a massive run in the market. We have been seeing that over the last year. Since the Fed paused rates, we've been up over 1,000 points in the S&P 500. So again, this is not some sort of video to come out here and scare you and say we're going to get into a recession, but it's an educational, hey, take a step back and just do some observations for yourself. Take a look at what's actually going on in the underlying economy, because anybody who's seen The Biggest Short knows that the market was kind of ignoring all of these signals underneath and saying, hey, things are great. Keep on pushing. We're making tons of money. We don't care. Obviously, what we're doing must be working, but you don't know. Similar to like when you're health and fitness, you're smoking. Sure, smokers, you feel great. Hey, that's awesome. You feel great. Your stress comes down. That's awesome. But the long-term ramifications are horrible for you. It causes all sorts of health defects, emphysema, lung cancer, whatever it is absolutely atrocious and horrible for you, and its long-term effects. So that's the same thing that's going on here. You have to look at the underlying economy and the health of that, because there may be some underlying pieces that are going to be causing some major problems down the road. And just because things feel good in the moment right now on the surface doesn't mean that they're always going to be that way. So just take a step back and pay attention. And again, we've got the data points to look at. We've got the jobs reports to look at, unemployment, CPI to make sure inflation is staying in line. Take a look at the credit and what's going on with people's credit cards, consumers spending money. What's going on with small businesses? How are they doing? What's the health of them? Because America really runs on small businesses, not just Dunkin' Donuts. America is running on small businesses, and those small businesses coming up. And yes, rates getting cut will help small businesses, but again, that lagging time frame from the rate hikes to the rate cuts could cause some major problems that we still are going to feel from those hikes going forward over the next few months. And again, timing wise, I've been saying this, it could be in Q1 or Q2 of next year that it finally breaks. And so, yeah, we could see those things right now breaking underneath the surface, and like, oh, well, maybe the Fed is going to give us that soft landing and it's not going to be a big deal. But you see what's going on underneath. And if small businesses continue to slide and we see a lot more bankruptcies going on, I mean, Tupperware just went bankrupt. So we've got a lot of companies out there that are seeing problems. FedEx just reported that they're seeing a lot of companies and packages getting paid for on a lower level. They're not paying those premium prices anymore. So when you see that going on, people are running lower on money. They're trying to save money and save costs wherever they possibly can. Eventually, we'll get to a point where there's just no more money to be had out there, and boom, you fall off a wall. And interest rates, somewhere that somebody is paying on their credit, is most likely going to be that tipping point. And again, maybe it's not going to be in mortgages, but it's going to be somewhere that's going on because that underlying effect is still happening right now, despite the fact that rates are being cut. You got to question, why did the Fed cut rates at 50 basis points right now if they said that the economy is doing well? Why wouldn't they just do 25 or heck, just leave it where it's at? Why would they be doing that if we are seeing that? So, sure, inflation has come down and we've seen unemployment going up and the rates don't need to be this high. But then why wouldn't they do a 25? Why the 50? Why kind of shock the market a little bit more right off the bat? Again, these are things to pay attention to. And if the Fed does a 25 basis point cut in November, it's going to be the second signal coming from the rate cuts alone that are going to be a very eerie similarity to what we saw in 2007. So again, I hope the Fed can pull this off. I hope we don't get into a recession. I hope we get the soft landing, but I'm just kind of following historical data, following trends, following the underlying actual reality of what is going on in our economy right now to make sure that I'm positioning myself in many ways, not just in my portfolio, but just to make sure I am safe and secure financially from where I am on a living standpoint in case we get into a tough time over the next 6 months. And it comes quick. So obviously timing the bottom is going to be impossible. And you will have some time as it's coming up. And, if we recover from this as we did in 2009, then it'll be a good time to buy. We'll have a good, 2 to 3 year window to buy. And realistically, if we do run for the next 10 years, then hey, at that point, there's really no bad time to buy. You're just buying and it's going to go up from there. But obviously buying at an opportune time where the market is even lower and really beat up is going to be even more beneficial. So I'm prepared for that. I'm getting ready to potentially maybe sell one or two more of my stocks to give myself more cash to kind of get ready for this. So I'll let you guys know what I end up doing for those moves if I end up making those moves. But let me know your thoughts in the comments below. Is this eerily similar? Do you guys see any other issues going on? Do you think I'm crazy and maybe there's no issues that are going on and I'm overthinking it and just being too ultra bearish? Let me know your thoughts in the comments on this. Don't forget to hit that like button down below, subscribe to the channel. Thank you guys so much for watching. I appreciate all of your support. Have a great one.